Chaos is coming. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, it's on our emergency alert as the global banking elites brace for an international currency crisis. And this is coming at a time where we're already seeing a massive collapse in international lending, which when you pair with, as you're about to see, an all-out currency crisis, well, that's not only just the fastest way to destabilize an economy, it's also the way to plunge the world economy into an all-out financial crisis. And something we predicted is happening. I'll show you why this is bad news for the U.S. economy. Plus, we have a sponsor for today's show. Avicanna is back. You can find them on the TSX under the symbol AVCN and on the OTCQX under the symbol AVCNF. And this company just posted a massive 500% profit. And their stock, from a technical basis, has been making a series of higher lows and is about to break out to what we think will be a 43% move to the upside. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Bloomberg because I really need to set today's story up so you can understand just how fast this currency crisis could cause the global economy to unwind. And herein sees a huge impact from widening divergence between the Fed and the ECB. And this is a challenge because we are indeed in a globally synchronized economy. And this means, of course, synchronized monetary policy from the central elites. But right now, the Fed is keen on keeping rates elevated at their current level. Meanwhile, we're already starting to see central elites from around the world either start to cut rates or begin the process of. And this is going to create some massive dislocations in the international currency market, which could easily spark an all-out crisis. And slowing growth and sharper disinflation in Europe could prompt the European Central Bank to cut interest rates as often, if not more than the Fed, which was unimaginable a few months ago. Now, this is important because nobody believed inflation could come down, and we said this was going to happen. Now, no one believes it's going to happen in the U.S., but hang tight over the next couple of months. So the challenge now here in Europe is demand is plunging along with the consumer price index, and the only answer the central bankers have is to cut rates. The challenge now is that causes some massive problems in the currency market. The potential discrepancy between the pace of Fed and ECB easing is having a huge impact on relative pricing between Europe and the U.S. You do not see that in the bond market, or you do see it in the bond market. You see it in the currency market, he adding that the parity between the euro and the dollar is a possibility. And this is something that on face value, not a lot of people want because it's going to cause some massive problems. Now, at first, the Fed is going to love this, but the U.S. economy, as we'll see a bit later in the show, well, it's not going to like it at all. Herein also spoke ahead of the new U.S. Consumer Price Index data on Wednesday, a crucial indicator for U.S. policymakers that is expected to show core inflation easing slightly in March. He also argued that the central bank's longer-run inflation expectations should be revised higher as macro conditions like supply chains and productivity evolve. Of course, this is always the case because inflation doesn't fall fast enough that this means we need to adjust our parameters. The reality is, indeed, inflation's coming down. And if the ECB starts to cut rates, well, the problem is you have the issue where the euro is likely to drop in value significantly, and that means more upward pressure on the dollar, and that is exactly the recipe Fed Chair Powell wants to get rid of inflation. Because here you can see in the consumer price index, now we're looking at U.S. data, so just flip this upside down if you're thinking what's going to happen in Europe. They're going to get inflation, which is not exactly what they need long term, but they need to spur demand. A weaker currency tends to help that. But here you can see the nominal broad dollar index in red, and there are times when the dollar index rallies that is very clearly disinflationary and sometimes outright deflationary, but most of the time you see disinflationary effects of a rising dollar. So if the euro goes down, now keep in mind, this is all because traders expect that the currency follows monetary policy. So if there is cutting involved in reduced rates, that means the currency goes down. That puts upward pressure on the dollar. And that is exactly what Fed Chair Powell needs to help get inflation down to the level he wants. The problem is demand is going with it, because here we look at Europe and you can see their share of global exports is shrinking. Now, this is the reason why they're having so many problems in their economy to begin with. But when you think about fiat currencies, it has very little to do with monetary policy other than the fact that that's the expectation. It has everything to do with demand for the currency. Well, if you're seeing weaker exports, that means less demand for your currency at a time when speculators are going to look to drive it down in a big way, and that will be your catalyst for this destabilization effect. In fact, during the next cycle, the EU would need to carefully calibrate its economic security measures to avoid a negative impact on Europe's competitiveness. The real issue here is not that, but the fact is it's a currency-related issue, and refrain from overloading trade agreements with pursuit of other policy objectives. So you can see they've kind of got this backwards. In fact, a weaker currency would likely help them a lot, because that would take, of course, demand from the U.S. and position it to a lower cost producer that has a weaker currency, and that would help cool off the U.S. economy as well, because here you can note the periods where the dollar is rallying. Now we look at exports of goods and services on a year-over-year rate of change, we can see a deceleration and even a contraction in exports. And you can note periods of the dollar increasing do lead to a downward move in exports. Of course, what do we hear from central bankers? Well, that we would love to cool off the U.S. economy. The problem is, as you're about to see later, the U.S. economy is not nearly in as great shape as everyone wants you to believe. And now this takes us, of course, to what's going on with the bankers and why they are having such a problem here. It's all related to monetary policy. As Eurozone firms' loan demand fell substantially, this according to the ECB. Now keep in mind that, of course, in the way it works, commercial banks create money when they lend, and so when you see a decline in lending, it's bad news for a debt-based economy. It means further pain is coming at a time when the ECB is already late to cutting rates. This is an issue because in their quarterly bank lending survey that's published today, it showed that credit standards, the bank's internal guidelines or loan approval criteria, were a little tighter for firms across the 20-nation bloc, meaning it was harder to get a loan. And there was moderate easing for mortgages for the first time since late 2021. But high rates, as well as lower fixed investment for firms and lower consumer confidence for households, exerted dampening pressure on loan demand. The substantial decline in loan demand from firms contrasted with banks' prior expectations of stabilization. But that's the problem, because when central bankers invert yield curves and money curves, well, lending goes. And sure enough, here you can see the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes. This against the yield curve. Now we're looking at U.S. data, and what happens here is you see the red line, or the 2-year yield less, or the 10-year yield less the 2-year, is shown inverted, meaning the short-term rates are higher than long-term rates. Now the issue for banks is they borrow at short-term rates and lend at long-term rates. During these inversions, well, they don't make money, at least from the traditional sense, on the interest rate spread. So what do? They tighten standards and make it more difficult for people to borrow money, and that affects the credit creation mechanism. Here you can see it very clearly that following inversions, banks tighten lending standards, and it doesn't tend to get better, because when the Fed or the ECB in this case starts to cut rates, well, that means the yield curve starts to steepen. That means any potential for the banks to make money on lower interest rates, well, that gets even worse, and lending standards get even tighter, and you kick off what is going to be the next global recession, maybe now centered in the Eurozone. As weaker firm loan demand raises the risk of an investment slowdown later this year, it actually means that exactly. This is a clear indicator that monetary policy remains too tight in the Euro area, which is absolutely true. It's been too tight for far too long, and this is what the impact is. And we'll look at some U.S. data here On commercial industrial lending, here we can see that in blue. This is a weekly data shown on a year-over-year rate of change and what happens when the dollar goes up. What happens? Exports go down, demand starts to fall, demand for the currency goes down, demand for lending goes down. Here you can see it very clearly. Yet periods of a rising dollar tend to either slow or decelerate lending growth time and time again. So if we were to see the euro weaken and the dollar go up here, well, it's bad news for the U.S. economy, not just from a lending standpoint, but it means demand's coming down as inflation further falls. This puts the Fed finally into cutting mode, but that's not the good news at all. Banks continue to enjoy a marked positive impact on their net interest margin over the past 6 months from the ECB's rate hikes, through the cumulative effect is expected to diminish over the next half year. While corporate loan demand may decrease further in the second quarter, make the case that that is likely what's going to happen. It should pick up for households, but it's not. Because households, when they start losing their jobs, which occurs, of course, when we see lending standards continue to tighten and inflation comes down, they have no capacity to borrow. Yet lenders expect moderately tighter credit standards for firms. Now, of course, what's going to happen? All-out recession. And this puts the ECB Fed split, igniting the talk of the euro sliding to dollar parity. And that means, of course, bets on a rising dollar and weaker euro are going to come into play. Of course, subscribers to our reports will have all of that on the technical and machine positioning. Check out those links below for a free 30-day trial. Start making some money trading, and yes, with currencies too. The dollar would just go through parity like a hot knife through butter if the Fed holds rates while the ECB eases. This from a chief economist at LBBW. The bank forecasted the euro sliding to 101 in 2025. The most bearish forecast for those compiled, of course, by Bloomberg, this being a dangerous situation. And you start to see these destabilization effects. And of course, central bankers have no clue how to solve the problem. Their only answer will be as the banks start to go under due to the fact they're going to see rising delinquencies, weaker loan demand, and currencies plummeting. They're going to panic in a big, big way. And everyone thinks the U.S. economy, well, is immune to this. But if you're long the U.S. equity market, what you're about to see is not good news. As U.S. small business optimism now falls to more than 11-year low. This is a danger point for the U.S. economy as the index of sentiment fell 0.9 points to 88.5, the lowest since the end of 2012. It marked the 7th decline in the last 8 months. Now, it wasn't long ago, of course, we can go back more than 7 months that this was rising. Everybody was hopeful. I said, look, small businesses are optimistic. I said, look, if this thing rolls over, this is likely transitory. It doesn't make any sense other than there's hope built into here that when this rolls over, eventually it leads to layoffs. And that is the challenge that small businesses are facing because owners continue to manage numerous economic headwinds, not a good sign, as inflation has once again been reported as the top business problem on Main Street, and the labor market has only eased slightly. Now, the issue here is the net share of small firms expecting higher inflation-adjusted sales. Now, we talked about this in the past. This is something they desperately need, and they weren't getting. They need to see sales go up, and on a nominal basis, we saw it, but on an inflation-adjusted basis, we didn't. Meaning they're getting squeezed here at the margin. And if that doesn't happen in the next 6 months, well, those number of firms fell to minus 18%, the lowest since May. Credit conditions also deteriorated, no shock, and small share of firms now said it was a good time to expand or make capital outlays as they get into conservation mode. And it makes perfect sense because when we look at the consumer price index here shown in blue against advanced retail's trade, but we're going to do these sales in inflation adjusted numbers. So we're going to adjust advanced retail sales shown in red for inflation or real retail sales. You'll notice that recessions are marked by period where real retail sales are negative. And you can see that here in the dot-com bubble, the global financial crisis. We'll exclude the pandemic, even though we can see it happen there. But look at now, of course, we hear the U.S. economy is strong, robust, and on the backs of a very great labor market. The challenge here is when retailers are not keeping their heads above water, they eventually start to lay off, and that is dangerous news because they mentioned tightening credit standards. Well, of course, we know that when consumers lack the ability to get credit, they can't buy things they don't need with money they don't have. And sure enough, we look at the net percentage of domestic banks tightening standards for credit card loans, and what do we see? The advanced retail sales, or real retail sales adjusted for inflation. Well, it makes perfect sense. As banks tighten credit card standards, what happens? People indeed spend less. Retailers get into big trouble. And just as they were getting optimistic 7 months ago, they're now starting to realize that the future path of the U.S. economy is not the hope and optimism everyone told them. And that means for the U.S. equity market, well, a bunch of danger signs. Because here we see the Wilshire 5000 price index, or the total U.S. stock market in blue, against real retail sales. And you can see decelerations of real retail sales into recession is ominous news for the equity market. And why that makes sense is because what are investors hoping for right now? Well, they believe their profits and earnings are going to go through the roof in a big way. And what we're seeing here in the small business index, optimism index, is that is unlikely to happen. Go back to the global financial crisis. What we see, a deceleration in real retail sales. There goes the equity market. Now we're seeing the same thing. And the stock market initially reacted accordingly until investors believed otherwise, now driving it to new all-time highs. Meanwhile, we continue to see cracks in the lending market, and we've talked about how that is dangerous. We continue to now show that small businesses are struggling. And what about the Fed? Well, here we can see from a former member, Bullard says 3 Fed rate cuts this year. Well, that's his base case. Not a voting member, as he's an ex-Fed official. But look at this. He said that a soft landing for the U.S. economy is moving into view. Well, that's not the case as we look at small businesses. He cited the fall in core personal consumption expenditures data, the Fed's preferred gauge of underlying inflation, as evidence of the dramatic success of its policy. But one thing we do believe is going to have a dramatic success. That is the stock for our sponsor today, Avicanna, who again, 500% increase in profits. This is incredible. This is setting up a big move in their stock. Well, we'll show you what could potentially be 43%. Again, all the information, pin comment, description below. Let's check them out. Here you can see they are at Avicanna.com. And what's the big deal about this company is they are driving biopharmaceutical advancements of naturally derived and evidence-based products. Here recently, back in March, they just released their announcement of RHO Phyto Microdrop 100, a 10% CBD THC-free proprietary oral formulation. This happened in Canada, and what's really driving it is their audited financial results from 2023. Check this out. Revenue growth up 314%. That is incredible, largely driven by the acquisition of medical cannabis by Shoppers from Shoppers Drug Mart and the launch of MyMedi.ca. They've seen substantial revenue growth that was achieved with a 19% increase in operational expenses. Their North American gross margins improved by 28% to reach 45%. Their gross profits increased by a whopping 500%. This is incredible. It was a tremendous year for Avicanna. What we think is setting up a tremendous move in their stock because, again, this all started back with their acquisition of medical cannabis by Shoppers. This was a smart move. And let's talk about what could be a smart move for your trading account. As we look at their stock now, we're going to zoom out to the 2-year chart. And I want you to see as the stock is moving between supply zones and making a series of higher lows, which from a technical basis means it's likely to break out in the near-term future. Here you can see a low set. We can come down to the MACD and see that momentum bottomed out and turned higher. And notably, the RSI never got to oversold territory. Now it happened again. Now you have a higher low forming here as it raced up to the upper supply zone, pulled back, buyer stepped in at a higher point. That is a positive sign, drove it right back up into that same supply zone with a big one-day move to the upside. Again, we see the same setup. RSI not getting to oversold, MACD getting down there, making a positive cross, heading higher. Now we're seeing right on the 2-year volume profile, which is where buyers have been at over the last 2 years, everywhere underneath. Price is now holding here, which is setting up that move of a 43% to the upside. Here you can see today's trading, very clear volume profile underneath over the last 90 days, sitting right at that 2-year volume profile mark, setting up a move up to 43 cents, currently trading right around 30 cents a share. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.